GDP second quarter estimate came out earlier this morning and remained unchanged at 0.3% quarter on quarter and up 2.4% year on year. I'm joined now by LCG's Ipek Ozkardeshka. Ipek, tell me, the market was actually hoping for a revision up to 0.4%, but, obviously it remained unchanged. Does this really actually mean anything, though, in terms of the path of recovery for the UK?
Well, we believe that we have not been that much disappointed. We have seen a slight deviation from the 0.4% expectation. We saw that the UK's growth has stayed stable on 0.3% on quarter. This is not bad news. Moreover, when we look at the PMI services, which is 80% of UK's economy, we see constant improvements since the beginning of the year, which means actually that this growth number of the first quarter should be revised on the upside in months ahead, and we are looking for a revision on the upside at least 0.5 to 0.7%. So we have not been disappointed. We are just waiting for further figures to come in just to confirm our optimistic view on the UK economic growth.
Okay, we've also seen again a modest rise in UK mortgage approvals. It was better than expected for April at 42.1 thousand, and total business investment as well. Again, a modest rise there, positive reading for 1.7%. Is the housing market activity now gradually on the turnaround?
Well, actually it is, because we have seen, this is about the whole economic growth, right? We have seen that it all confirms our expectations of a better growth and a better economic situation of the UK in the first quarter. If you look at the employment market, the unemployment rate has now hit 5.5%. The wages growth has been good. This means that when people have money to save and to invest, the mortgage market, the real estate market is the first place to go, because the other parts of the economy, when you look at the stock markets and the bond markets, the rates are very low and the volatilities are very high. So the real estate market remains the best place to invest for the retail investors, which means that the mortgage applications, the mortgage applications will be higher if the positive trend in the UK growth continues, and we expect some more activity on the real estate market, which is obviously not good for the BOE, because this brings out the question of whether the BOE is keeping the rates too low, and whether we might expect an upside readjustment before the end of the year, and we might look at November just to cool off the overheating in the real estate market if that happens.
Sure. In terms of looking at sterling for a moment, sterling against the US dollar, it fell after the UK GDP data, also yesterday after the Queen's speech as well. What kind of levels now should we be looking out for sterling against both the euro and the US dollar over the coming days? What are going to be the influencing factors here?
So looking at the sterling from the UK, the game is over. We have seen Queen's speech, which has been negative for the sterling overall, because of the EU referendum, because of tighter fiscal policy, which might keep the BOE on a cautious tone regarding its monetary policy. We have seen the growth number, which has quite disappointed. So the cable just hit 153 yesterday, and now we are just consolidating losses at this level. Now the big question is, what will the US growth be, and that's going to be tomorrow. The expectations are quite dovish. Actually, we are expecting 0.8% contraction on quarter annualized in the US. If that happens, actually, this means that the positive expectations about the US economy will fade. That might pull the dollar lower, and in that case, we can look back to 155 levels in cable. Otherwise, if we have some positive news from the US, 150 will be back in radar. Regarding the euro, sterling, the 70 pound, 0.70 pound is still the most popular target.
Okay, all right, lovely. Thank you very much, Ipek. Join us later on today for more market news and analysis. But for now, goodbye.